Hey, what's going on, Marziti? It is, man. The day ripped by. Yeah, over the years, when I first started doing those 0 day trades, I was doing them every day because, I was like, why not? They're back then we had Fridays and then we got the Monday, Wednesday, Fridays. And I was so excited. I was like, well, I'm going to do them every time we got one. And then, of course, we had the Monday through Friday. And over the years, I got to the point where I was like, I want to do them when I've got a really strong indication that the high is in or the low is in, and I like them in the afternoon. And that has served me really well. But things get in the way, like the 1 o'clock auction will screw it all up, or the FOMC, of course, I don't really like doing them on those days, but there there's things that will set up really nice, and then it's like, no, I'm not going to do it because maybe the White House is going to have a meeting or somebody's going to be running their mouth at 1 o'clock, and so the opportunity doesn't show up as often as I would have wanted it to once I started getting more picky about it. Now, here's something to think about that I've done, say with like the SPX on 0 days. In the afternoon, if we're at the lows, say around 1 o'clock, I will target the highs and see if I'm willing to buy a call at the high of the day, right? And the only reason I'm willing to do it is if it's really cheap, like 5 pennies, 10 pennies. I throw it on there and I don't expect to really get the win. I'm just willing to get the risk, right? So I'll throw it on there. They don't really play out as often as I'd like. Sometimes I can break even. A lot of times they just go to zero because they're so far out of the money. But when they hit, oh man, I've had, $1,300, $1,800. And so it more than covers the loss. It's just another one of those where it's got to set up well and you lose more often than you win, and that is demoralizing, degrading. But I do like that. Or the other thing that'll keep me out is I'll go to target like the high a day and they still want, like a dollar something for it. I don't want to risk a dollar something for it. There's no, it doesn't have a high conviction. And so it's like, I'm not throwing a dollar at you. You're not convincing me that it's going to work. So if it's too expensive or if there's just too many things in the way, I don't like it. But that one, I got to admit, it when it hits, man, it makes some good money. Yeah, people seem to like it. There's a lot of moving parts for sure with OPEX next week, triple witching no less, and FOMC next week. Really got to take into consideration that. And then the administration is pushing really hard to try to wrap up this thing with Iran. Of course, we just had a headline come in, and so I don't think they're going to be able to wrap it up as easily as they wanted to. Well, looky there. Volland is showing up in financial juice. Wow. I'm gonna have to give Jason some fun on that one. He got himself a new contract somewhere. I know the guy that owns this. Really nice. So let me make sure everything is recording. On the last stream, the restream didn't record. So, yep, it is recording. Everything looks good. I think I'm going to just go ahead and put my own money into restream so that we have an account there that is streaming at 1080p. Because right now, it's the Bullish Bears account and it's, I don't know, like the lowest, cheapest form. So it's like 720 or whatever the low end is. So I'm gonna have to just bump that up, get it up there, so we don't have to run these Zoom streams. We'll just be able to run it right through Discord like we used to, and have it record at the proper whatever imaging. So with your 0 days, are you running close to the money, near the money, or are you? Well, the SPX, you're almost never going to get that 50% unless you do go deeper in the money. Like you have to handicap your trade and give them positioning to get that 50. Whereas if you were trading, like Apple or something, you could run it right at the money and get a fair value for it. You will not get that in the SPX. And if you do, you should be worried, right? Like if they're making it look good and you build it at the money and like, oh wow, look at that. They're giving me half. Don't take it. It's a lure to draw you in because they want you to take it. Oh yeah, no, 100%. I was certainly not recommending doing it on there. Just from a pricing standpoint, we're looking for half the credit. And when you build it on the SPX, you just never get it, right? And then when you do, you should be concerned. But if you put it on something that's not the indexes, you'll nearly always get the width of the spread in half unless there's something wrong. Then it'll come up short. So it's kind of like just getting familiar with the contract, and being aware that it prices oddly, you know? Yeah, bring it. On which? Okay, let's see. Okay, the blue one is the at expiration structure, and the purple one is the theoretical right now value of the trade. And as you adjust anything within the trade, the purple line will shift. Say, like if you move time forward or move volatility forward, then that purple will shift to reflect the changes from gamma volatility or price that you might apply. Right. Well, see if it's $5 wide, so your max profit would be $5 minus $1.33. So that'd be $3.67. The there's so many ways to run those 0 days. Like we were talking about buying an out of the money call, and you can do like an out of the money butterfly. Those are really cheap. I've done that. If I try to buy an SPX high of day call when we're at the lows and I don't like the price, I've done, high of day butterflies instead. Um, you can do the vertical at the high a day as long as the outcome is something really cheap, right? Like a $5 5 penny butterfly or a 5 penny vertical, something like that. I just find that um, if the call itself is usually too expensive, then anything I try to build is usually too expensive too. But you know, you can find it sometimes. That's why it's worth poking around, just to see what you can get. And it really depends on how far we've fallen and then how late in the day it is. One of the questions that I got during the morning briefing today was I'll just read it as I got it. I understand all the markers, the point and control, pivot points. The challenge for this person is the entry. What is the basic strategy on entry points? And of course, the morning briefing, I just don't have time to get into questions like this. So I grabbed it, I captured it, I saved it, and I figured we'd go through it now instead, because this is a question that I get quite often about, well, how am I supposed to get into this thing? And usually, what I find out is the person doesn't have a tradable plan and they're looking for someone else to provide that. And unfortunately, there's this just not a good way to do business because we all have to decide for ourselves, how am I going to get into this thing? There's some basic market wisdom that is really popular, so we can discuss those. At the end of the day, you got to play the lawyer's argument and look at, well, what are my choices? And from those choices, which one of those do I want to use? So, of course, options and stock are different than futures, but at the end of the day, it's all execution. So, one market wisdom is wait for the current candle to close and then get in on the next candle. That is okay, but what if the current candle is a big monster candle like that drop we saw at 1:30 when the headline hit about California and drone attacks? That big bar, if we was waiting for it to close, it went all the way down, punched through the low of the day, put in a new low of the day, and then bounced back. And now we haven't been back to the low of the day since then. So if we was waiting on it to close, we missed the whole run from the rollover down to the low of the day simply because we were waiting for it. So when I get these kind of questions, what I usually do is I ask the person, what are you trying to accomplish here? And it usually is an answer that sounds something like, well, sometimes I get in and it loses. And I was thinking that if I had got in at a different point, I wouldn't have taken the loss. It's good in theory, but at the end of the day, if the trade is going to be a loser, it's going to be a loser. The entry might save you a little bit of pain, but a loss is a loss. You got the direction wrong. So waiting until there's quote some better time to enter is not really relevant, right? You have to get in and you won't know that it's a loser until it starts to lose. The longer you wait, it can help you not take the trade at all. If you sit and wait and watch and realize, no, this isn't working out. I'm glad I didn't take that trade. Well, great. You never got in at all. And so you didn't take the loss. But there's no way to time the trade where you can avoid taking a loss simply by having gotten in at the right time, or that you realize that the trade isn't going to work and you never get in at all. So if that is where the question comes from, sorry, that's not how trading works. Losses are going to happen. There's no way to identify in advance that this particular trade is going to be a loser. You just have to pull the trigger, take the trade, and if it starts to lose, get out. Try to keep your losses at a minimum because losing is just a part of trading, and that's just how it goes. On the other hand, there's the techniques for getting in. One is waiting for the candle to close. As I've just discussed, that can leave you sitting out of the whole trade. If it's a breakout trade, like we had earlier today, we had the high of day. And then when this blue candle was alive, price ran up off of the lows, closed here, the new bar opened, and it shot through to the high of day and it kept on running. And then it reversed and it came back down again. If you had waited for that candle to close to go long, you never would have went long, right? So yay, cheers. But on the other hand, down here, if you had waited for that candle to close to go short, then you would have been getting in way down here after we broke the low and we came back in again, and we haven't been back down there since. So waiting for the candle to close can be beneficial because it can stop you from getting in on a fake breakout or a fake breakdown. But on the other hand, it can also cause you to miss the entire move. Sometimes, however, getting in when the candle is alive is really helpful. So on this breakdown, I like to focus on getting into candles when something happens that I am looking for. So on this breakdown with the news from California, price broke the low of the previous bar. I like that. That's one of the triggers that I like to use. It also rejected the midpoint of the previous bar, and I like that. So the bar closed, the new one opened, it ran up, hit its head on the midpoint, started to fall, and broke the previous bar's low. You've got three different entries right there. Well, four. You can get in when the bar opens. You can get in as it tags the midpoint, after it crosses back through the open, or after it crosses the low of the last bar to your left. I like all of those, and depending on how fast it moves, I might choose one of those four. For an example, I might want the mid of that previous bar, but if it gets there really fast and it leaves there really fast, well, it doesn't matter if I want it. If I'm not fast enough to take it, then I'm going to miss that mid. Then if it comes back down and crosses through the open, okay, or the close of the last one, that's one that I could catch sometimes. Sometimes that goes really fast too, and then I miss it. And then it's breaking down through the low of the last bar, and I can catch that one on the run. I like all of those. Now you can try working those into your system and see which one you like best. Maybe there's one or two of those that you're going to try and you're going to think, I don't like this at all. Screw that. It sucks. Great. Then don't use that. If you find one you really like and you want to stick with that all the time, then, do that. I have found that always isn't really a great way to do things, right? Sometimes I'm going to do it one way. Sometimes I'm going to do it another. And then sometimes the darn thing is just too fast and I can't get what I wanted, and I'll take what I can get. In all of these scenarios, if the trade was wrong, I would not have known until after I was already in, and then I would end up with a loser, or I'd have to defend it in some way, right? So if the question came from, I just don't want to lose the trade, and I'm hoping I can identify a loser before I get in, yeah, well, unfortunately, that's just not how it works. So hopefully that covers the what's the strategy on entry points. There is more to the story. If we have a pivot point that we're targeting, say the high of day, and price gets to the high of day, we had that example earlier. We had our high, price ran back up from the lows and got to the high. If we were looking at that for a short, when would we short that? As soon as price touched it? Well, we would have taken a lot of heat if we did that. After we crossed back down below it, well, we did that in the breakout bar. And the next bar would have given us some heat, but it still started working in the right direction. Do we wait for some sort of signal pattern setup? For me personally, I like to see reversal bars here. A nice 2 bar or 3 bar swing over, something really nice. Say an evening star reversal, a doji bar, a really clean doji bar, something like that would be great. But what if you don't get it? Kind of like what we had today. This is just some crazy trash. Then you didn't get it, and you still have to try to make a decision. Do I still want to short it here or not? This isn't even a really good setup, which I think is a perfect example to use because we don't get the good ones very often, right? You have to get used to dealing with the trashy ones. So, at which point would you take this? Once you're finally convinced that it's going to turn around, right? And the better that you can read price, maybe order flow, the dome, any additional information that you could apply to this to be convinced that the high is going to hold and that we're actually going to roll over, that would be the point where you'd want to get in. Since we're not seeing a pattern or a candle setup, you would have to decide from some other criteria or you just have to let it go. Don't be afraid to just let it go. Now, of course, if you're using options, then a lot of that doesn't apply. You would just have defined the high of day and the fact that we've rejected on it or we're testing it, and then you would just lean against the play of the trade and take it short. The options trade doesn't necessarily equate to a specific options price pattern or candle behavior. It's more about what my bias is on the day. I think we're done going down. I think we're done going up. I think we're going to hold the range, and then you put on the options trade. So hopefully that covered it. If not, um, please feel free to reach out, ask more questions on this topic so that I can better understand where the question comes from and then, help resolve this because I get it. If this is where the person is at in their trading career and they're stuck, then we got to help get them past that point. Cool, cool. I don't see them in the chat, so that's why I'm saying it that way because they're not here. Last week, we were asked about sentiment indicators. There's quite a few of them out there. Max Payne is one that, for some reason, continues to be really popular. I'm not a big fan of this, but I can't argue that it's popular because it really is. It's not the most popular. That happens to be the put call ratio, but Max Payne is kind of a big deal. A lot of people like this one. You can calculate it on your own if you want to do enough legwork. I don't ever do that. There's websites that'll do it for you. Basically, max pain is where the greatest number of options on both the call side and the put side would expire worthless, and that behavior can cause a pinning effect. It works best on liquid products, which should make sense for anybody who trades options. It's most relevant on the day before or the day of expiration. So it's not helpful if you're looking at, say, a swing trade 30 days out, that it's just not going to be beneficial at all. And then it is a good indication of where the crowd is at. And really, there's so many modern tools that can help you spot the crowd and show you dealer positioning while you're at it. That this antiquated tool is more noise and trash than anything else, in my opinion. And I've been known to be wrong. My opinion is not the gold standard of trading. So, if you like it, great, use it. I don't. I won't. I thought so too. I read that definition last week. I don't like the darn thing. Tell you honestly, I just don't like it. But people just eat this thing up. Well, yeah, in the afternoon, we're not in such a rush. We can slow down, really get some Q&A going. Um, Oftentimes, I've got a topic prepared that somebody has asked about, and I try to be as open so that people can participate and ask questions and get topics covered in detail. And that's really hard to do in the morning stream. I remember I used to do those morning streams myself. It's it's just not a really good format for Kevin to try to apply that. So I understand why he wouldn't want to. Yeah, I mean, I'll take a trade in the afternoon if I find something that I want to trade, but a lot of times I don't even look. We're on the Quick Options website, and I know they have Max Payne in here because I've seen it. But it seems like they kind of added some new tools recently, and so I'm poking around trying to find it. They do have it. It was in volatility. Maybe it was in open interest, but I thought it was in volatility. And I don't know. I must be just overlooking it at the moment, or maybe I got logged out. Yep. You know what? No, I'm logged in. I was about to say that would be a reason why I'm not seeing it. All right, Vol, Skew, Viper. I don't know what the Viper is. Got Gex, Open Interest, Timeline, Quick Skew. So, if you use it, you can calculate it on your own if you'd like. I would recommend finding a website that offers it and just realize that there's so many more newer modern tools that can give you that um, crowd insight that you don't necessarily have to go poking around against something so antiquated. Let me try a different product. Maybe it's because the thing that I was looking at was an illiquid turd. No, that didn't solve anything. That looks like a Max Payne chart right there. That's like an inverse Max Payne. So the definition, just run it back. The greatest number of options on both the call and the put would expire worthless and can create a pinning effect in the last day. And you can spot it the day before, but it would pin on the last day at expiration is what you would be looking for. Oftentimes, if you see price getting near it and the options market is going to expire that day or the next day, you can have a higher likelihood of price sticking in that zone over the course of the next few hours until the bell rings, holding like a magnet or a range. But with the modern tools that we have, I wouldn't dig too deep into Max Payne. Another one is put call ratio, and that one is the most popular out of all of the sentiment indicators. It is an old school one, but it's also still highly recognized. A lot of websites have this one, and you can calculate this one too on your own. It starts with a sliding scale that doesn't go below zero. So you got zero, slides over to one, and in theory, it goes all the way up to two. So from one, just keep going all the way to two. But there is no negative number. If you run across a put call ratio that's running negatives, check to make sure that they're not running some different version because there is more than one version. There's also one for different products. So right, if it's zero, you're going to want to know what. Yeah, you're going to want to know what's going on out there. Why is everybody so exuberant? So 2.0 means two puts for every one call. That's extremely bearish, right? To have 100% more puts than calls. 1.0 means one put for every one call, and we consider that neutral. A decimal below one like 0.7 would be 0.7 puts for every one call, or 0.4, 0.4 puts for every one call, and then 0 puts with only calls would be 0, 0, and that would be the theoretical floor. You can't get any lower than that. And if you ever see that, the data is wrong, or it's broken, or the tool really isn't a put call ratio, and you might want to read the instructions on whatever it is that you're looking at, because there are a lot of products out there, and you might find something that somebody called a put call ratio that really wasn't, or they adjusted the system somewhere. So I can't say that you won't ever see it, just it won't be your traditional put call ratio. It would have to be some newfangled thingy. You set the time frame. So um, you'll want to read the directions by wherever you're getting your put call. A lot of them will do the next expiry, so it'll be the put call ratio between now and the next monthly options expiration. Some will run on everything that it has, all the expirations. I believe the standard old school one uses everything. Some of the more modern ones are going to be more specific to a set expiry. The good thing about running this one is you're not trying to apply any sort of bias to what the options are. Because when a call gets traded, we got to argue, was that a call buyer? And even if it was a buyer, somebody sold it to him. Or was that a call seller? And even if it was a seller, somebody had to buy it. And did that close the trade, or did that open a trade? And was it part of an existing trade? And is there other trades connected to that call? So there's so many unknowns. And this just kind of throws all of that aside and says, this is what we've got right now. This is how much open interest we have on the call side. This is how much we have on the put side, and then runs the numbers. Another sentiment gauge we have out there is the buy right index. Not all platforms have this. You can get it at stockcharts.com, and you can get it on TradingView. This one does not respond as quickly as price does, because it is a formula, a math formula. What they're looking at here is, what if you bought stock in every company in the S&P 500, and then you sold calls on the shares of that stock in every one of the companies? As long as the market is going sideways, the buy right will outperform the index that is reflecting. So if you got the buy right monthly index for the S&P, and the S&P is sideways, this will outperform the S&P. But if you got the S&P ripping to the upside, it's going to underperform, because those short calls are going to be losing, even though you do have long stock. So when I use this, I take all of that math and mumbo jumbo and I throw it in the trash, and I just look at what is it doing. And I use this on the intraday. So from a day trading perspective, this is a great tool. There are analysts who use it on a higher time frame, like daily, weekly. I do not. It doesn't hurt to go out there and see where we're at, right? Are we near the highs? Are we near the lows? Have we rolled over? Something like that. But when I'm using it, most of the time I'm running on the intraday, and my evaluation is it rising with price? Is it not rising with price? Is it divergent? Are we going up in the indexes and down in this? Something like that. And then, where did it start? Are we pressing the high of day? Are we pressing the low of day? That's how I like to use it. When we had that news come in today about California, the ES dropped immediately. This did not. It took an extra 5 minutes for the options to start coming in to finally turn this thing around. and drop it down. So looking back at it now, we can see there's the red candle, but it didn't happen when the ES fell. So there's a smoothing factor to all of this. To me, it's really useful if you're trading in the indexes. I don't know that you would find much value in this if you were trading within one of those particular stocks within the index, but still, I do like it. The chart that I usually use is a grid that has something like US Japan on the left, buy right in the middle, and then the ES on the right. And that way I can look and see what Japan is doing and what the buy right is doing and what the ES is doing. And typically they'll all three be moving up, they'll all three be moving down, or we'll start to see outliers and divergence, which really is just a signal for me to be cautious. So I like it. Unfortunately, it's not everywhere, right? Like you're going to find platforms where you just can't get it. I'm not sure. I can't remember if I can get it on Thinkorswim or not. BXM. Yeah, there it is. All right, so we got it on Thinkorswim too. But if you're running like Robinhood or maybe even Webull, not sure. Can't say. You'd have to poke around and find out. So there is math behind it. It's not really relevant though. I guess it just depends on how you want to use it. Another one that's really popular is AAII. It's funny because this one, I didn't even see it this way. I looked it up to make sure that there was nothing I was missing that I could share with you guys. And it is considered the best dumb money contrarian indicator available. A lot of tools are designed to focus on what the dealers are doing, what the funds are doing, like VC funds and CTA funds and dealers and hedge funds and mutual funds and all these different quote smart money players. And yet this one is the best tool for looking at the street trader, the dumb money trader. Individual retail traders take a survey, and the survey asks a simple question about uh, what direction they think the market's going to go over a set period of time. And how they answer it is how the AAII index gets its quantifications for higher or lower. This is best used in its extremes. That I knew about because that's how I was always taught to use it. Look for the extremes. Um, the only place that I know that has this is stockcharts.com, and that's usually where I find it. Here's my stock charts account, and I've got my sentiment indicators in here somewhere. Bellwether, cryptos, currency, GDP, sentimental indicators. That's not exactly the one I want, I think, but we'll open that one. I'll just pop that. Yeah, there's AAII. I still think there's a better one, but we'll bring this one up since we're already here. Now they've added the bull version down here and the bear version because you can break them apart individually. And then they've got the SPX across the top. This isn't my chart. It just came as a part of the charting software that you can get on here, some pre-made charts. So, it's like, whatever, sure, why not? Uh, what's celebrities? Oh, yeah, 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 yeah. Yeah, no, that's not a right. That's not a bad idea, right? Surely there's some AI device out there that is picking the brains of all the influencers. That would be a good contrarian one, I guess, huh? I was on Temu last week and I found, the challenge coins in the military. You heard of those? they have these challenge coins for generations. So you can get like a Gen X coin. Oh, it's really neat. It's heavy. I ordered two. I got one for me and one for the wife. It's got like a skull and crossbones on it, and it has some snarky saying, and it's a Gen X coin. But I was telling one of my friends about it, and he's like, "I have no idea what the hell you're talking about." I'm like, okay, well, I'm just gonna have to get you one. I like it. I thought it was neat, so I got me and the wife one. Now I got to get one for my buddy. This is the one I was looking for. All right, so this sentiment watch list, I believe, has a different AAII chart than the one that we was looking at. Yeah, it's not much different, but I don't know. I just see this one a little cleaner. Um, same thing though. You're looking for extremes. So in the bearish extreme here, you can see April of last year. The um, bull bear sentiment gauge was really negative, way down like minus 35, minus 40. And that's where it really shines. Or if it's really bullish, and you can see we stayed long through that recovery when we came out of 2023 and into 2024, and we just kept pushing. You can see how the sentiment gauge just stayed lit up. So it's not a timing tool, certainly not something that you would want to base your trade on. It just gives you a tell of the crowd. But again, there's modern tools that can replace this and does at least as good, if not better. Oh, TradeyTix happens to have some really simple tools that deal with dealer positioning and uh, the retail side of things. And I think it's easier to read too. So I'll bring that over. I started it when it was on Microsoft. You can see how we're kind of really close to zero. But back here, dealer positioning was really negative. Now, if you think about that, if they were selling everything, that's because somebody else was buying it, right? The street, the regular retail people were buying it, so dealers were selling it to them. That made the dealers heavy negative, which implies the street was heavy bullish, or the retail. Then it flipped back here in late August or mid August. The dealer positioning went positive, so retail was selling, and yet we didn't really sell off at all. We kind of bottomed out right around the flip and kind of went back up, challenged the previous high. So now we're just chopping back and forth. So when I'm looking at getting into something and I just want to see at a glance, are the dealers really heavy on the short or on the long? Right now, it's worthless, right? We're basically at the zero line. There's no value to that. But if it was really negative or really positive, then I would get at least that sentiment out of it. Let's try Footlocker. What do we got on Footlocker? It was positive. Now it fell out of bed. AT&T was in the news. Maybe we get something. No, nothing out of ASTS was in the news because of AT&T. No, goodness, come on, give me something. Wait, got Caterpillar was in the news. Nope. Lowe's, not bad. Okay, we got a little bit out of Lowe's. That big move up today, you think would kind of fix that. I'd like to see how it ends the week. It's positive, not as positive as it has been in the past. Maybe not a good example either. I'm open to ideas. If somebody wants to throw a name out there, take a look, see if we could find something really pushing one edge or the other. Those EVs were nope, no EVs. Maybe Joby, yeah, a little bit. So that's kind of the idea. I like to just bring up a stock and see if I can find really heavy influence on one side or the other. Again, it's not the only thing that I would look at to take a trade, but it's nice to see where they're at compared to what I was thinking about doing. If I want to get long and the majority of the retail traders are already long, I'll probably second guess myself. These guys got all kinds of neat tools, though. I did grab the max pain calculation for anybody that wanted to do it. It's like a step by step. I think it's a lot of trouble. I don't think it's worth your effort, but to each their own. Hey Marzita, I hope you have a good afternoon. Always appreciate you dropping in. Let us know how that short went or whatever your day trade was. You're running a 679. Oh, you're headed down 665 for what expiration? Let's throw that over into the analyze tab and take a look at what we've got here. I I How wide did you build it? 5? All right. One of the things I remember at Tasty Trades is they were running a question that asked, um, is there any benefit to making the trade wider versus keeping it narrow? And while I don't remember the numbers that they were using during all of it, like with the actual 80%, 70%, I do remember there was a benefit to going wider. So when you're looking at this and you're thinking I could do $1 and put it on for like 3 pennies, yeah, but that has a really low win rate, and it's basically a YOLO snowball's chance in hell. Whereas widening it out 5 like this, you've got a much greater chance of actually making money on the thing. There is a point of no return though. If you was to make it 10 wide, 20 wide, 50 wide, then it loses that value and you just get back into YOLOs and train wrecks. But it was a really great video. I could try to find the link again. They discussed butterflies, iron condors, and verticals in the discussion about does making it wider make it better. And if I remember right, $10 was the cutoff if your strikes were $1 wide each. Because if $10 on a stock that has $5 wide strikes, well, that's not really that big. So even $2.50 wide going $10 wide, it's not really that bad. But man, when you're running $1 wide and you take it 10, that's pretty wide, all things considered. So in this, we're 5 wide on each side, which makes it 10, but we're still only focused on how wide is it from one direction, right? And that's a $5 wide butterfly, risking at worst 40 cents for a chance at max profit at $460. And of course, we don't aim for max, getting half of max is usually a really great goal for butterflies. So, if you think about 480 or 460, then you would be aiming for like $230 with a risk of $40. That's not bad at all considering why would you hold it to $40 loss, right? Most people won't. What's your exit if you are losing? What do you think? When we bring theta in, because it's a balanced trade, we've got two shorts and two longs. But of course, one of the longs are a lot closer to the money than everything else. The 670 put has a theta of $1.20 if we just round up a little bit. And the 665 has a theta of $1. So every day that option will lose $1 from theta, and the one closest to the money is going to lose $1.20. The long farthest away would lose 71 cents. And so we can add that up and we get 390 for your maximum amount of theta decay every day that this trade is held. And of course, we can apply that against adding up the contract's value, not the trade's value, the contract's individual value. So the 670 is worth, let's just call it on the bid, 290 and then $1.80. So that's 380, 470. And then we add another dollar, that's 575. Let's just round all that up together and call it 580. So you got $580 and it's going to lose 300 and something in a day. On the analyze tab, we've got theta sitting at $9.40. And if I move time forward one day, we can see that theta goes from 940 to 950. It's a little odd that it went up. And then if we take it to, yep. And then by the last day, of course, it doesn't show us what it would look like before expiration. It just takes it all the way to the end and it blows it out of the water. So we can't put it on the 0 day, but we can hover in front of the 0 day and we can see that it goes up about 10 points from 940 to 950. So yeah, I think by tomorrow afternoon, you'd really have to decide what you want to do with it. I have found over the years that when it comes to these kind of options trades, the Greeks that close to expiration will leave you scratching your head more than anything else. And you're better off basing your decision on whether or not you think price can land in the middle or not, or even in the window. Oh, yeah. Today was a rough day because of the strange headlines that came in. We had 10:30 data on the oil. And remember, oil's a really big deal right now because of the strategic petroleum reserves and their ability to knock the perceived value of gasoline at the pump price down. So that jacked us around at 10:30. And then at 1 o'clock, we had the auction for the 10-year. And then we had that headline come in today. That was three different intraday manipulations that shoved price around, and it had no bearing on what the candle patterns were or the price action. So as a technical trader, when you're looking at price and you're like, oh yeah, I see my lines, I've got my drawings, my pivot points, I understand what price is going to do, and then whack it, here comes a headline, and it throws it all in the toilet. That makes it very difficult to trade. Absolutely. The key to all of this is if you realize that that's the kind of market we're in, right? Because sometimes it's not that bad, and then other times it just sucks. When you know in advance that you've got those kind of shenanigans on the plate that they could come in today, you already approach a day like this with absolute caution. One of the things that I try to do in the pre-market and in the morning briefing is highlight, hey, what do you think we're going to get today? Right? Like I just start with that. And if today's supposed to be sideways and we're stuck inside of a narrow range, I base my trade decisions on we're going to have to leave this range if we're going to get anything done. If we stay in this mess, I don't want to mess with it. And if you look at what we were doing for most of the morning, we were sitting inside of the Globex, right? All the way up until around lunchtime. And then we dropped out of it. But we were in that Globex range all the way up until lunch, and we started moving through the lunchtime, which is odd. We don't normally move in the lunchtime. That's why I call it lunch. So there was a lot of warnings already for me telling me, hey, just be very cautious, be careful on this. Probably don't want to mess around. You're stuck inside the Globex range. And when you're in a range, there's a lot of manipulations. Lines and levels don't tend to work that well. Price stalls out, doesn't reach its next target. Just it's a big mess, right? So if you want your higher conviction trades, then leave this sort of price action alone. I'm not saying that you can't trade it, but the outcome is you will lose more often because you are inside of that price action, right? And that's kind of the the ticket price. It's what you're going to have to pay to play, and I don't want to. So I tend to not. Yeah, the NASDAQ is a perfect example of what I'm talking about. There's the Globex low, Globex high, and I mean, the reversal off the high, beautiful, beautiful opportunity. Not a good candle pattern necessarily. It wasn't a good pattern, but a really nice rejection. Probably showed up nice and clean on the dome. And these wick reversals, yeah, other than they came on headlines like that one I know was a headline, probably wouldn't have wanted to mess with it. I just don't fight this, right? And that's kind of the key. Higher conviction trades, I'm much more willing to jump into it. Here's the tricky thing that I see a lot of traders fall into this trap. And don't get me wrong, I have done it too, so I'm not pointing any fingers. But say you got a good size account, right? And it doesn't take much money to have a good size account. Say you got $3,000, $5,000, and it's a day like this. So you think, I'm going to trade small. I'm going to use some micros, one or two contracts. Who cares? I'll risk 20 bucks. And so then you see something that is kind of setting up, and you're like, yeah, well, it's all right. I'm going to try it. I'm going to try it. What do I care? It's just $20, right? And then you try it and maybe it works, maybe it doesn't. It starts to degrade your confidence, starts to make you doubt your ability, your strategy, the ideas, your all of it start you get this doubt seeping in there. What am I doing wrong? Why isn't this working? you know and then the frustration, the feeling like they're out to get you, the rug pulls, the shenanigans that they do, the fake headlines like yesterday when they tweeted just delete it, that just breeds more resentment, anger, frustration. So when you go to get in a trade, ask yourself, would you do it with a 10 lot on the large contract? Do you have that kind of conviction? And if you don't, you still want to trade it? Now, don't get me wrong. I will still trade it even if I say, no, I wouldn't put a 10 lot on it. But a lot of times that'll back me off and make me think twice before I take the trade. Because if I don't have the conviction to size up, then what am I doing? Like, why would I even try it anyways if there's just no conviction? We're all human though, and I do take trades even when I don't have that high of a conviction. But try not to fall in that rut where you think, well, I'm willing to tighten my stop up and give it a try. Why not? Let's see what happens. It's just $20 or $50 or put a number on it, because that can really degrade the confidence. And there's nothing more devastating to a trader than to lose faith in ourselves, our strategy, our ability to do the trade. Then it really goes to hell. Even right now, the discussion we're having about this opportunity to drop, this is a pure YOLO play at this point. We have no reason to think we're going to go down. We have no reason to think we're going to go up, right? There's really no reason to think we're going to go anywhere. We have nothing more than headlines that are jacking price around, and putting a trade on at the lows is just as good as putting one on at the highs at this point. You could even probably put one on at the money for all we know, right? Like, we just don't have any directional odds at this point because everything is being manipulated by the headlines. The good thing is if we can keep the risk low enough, then we can put the YOLO on and say, well, why not? I'm willing to risk 5 pennies. Let's see what we get. But I wouldn't want an entire account built out of YOLOs. And we know going in with our eyes wide open that we're putting on a trade that has, like a 5% chance of winning. The scary thing was when I meet people and they say, yeah, I put on this trade, it was $1,000 and I thought it was a really good trade. And then I go look at the options and it was a snowball's chance in hell of winning, and they ponied up $1,000 for it. You know what I mean? Like that's where I start to feel bad, because they thought they were getting a trade that had a high conviction win rate trade, and the options they chose had no chance in hell of being profitable. And then they dropped a lot of money on it. That sucks. I think we've all made that mistake at some point. It just sucks. So knowing that the trade is a high conviction or a high probability versus a low probability is kind of the key. That way, we're not fooling ourselves into taking a trade with the understanding of what it should do in its performance. Nothing wrong with a YOLO when we know it's a YOLO. Yeah, Austin, hop on in. No, I meant hop on in with your mic. I saw you. Oh yeah, you'll definitely need him for that. And try to catch Jeremy. Sure. Another one that you want to catch too is Jeremy, especially now that he's back again, because he might have resources on it. On the screen, I just snapped out a bunch of different tools on the Thinkorswim, and I didn't choose the same starting and stopping point. But what you would notice if you went through and started applying these is that their sequence lines up, right? Like the lower one down here at the very bottom, these half circles, the distance from each start and stopping point would be like the same distance between this spiral if I had started and stopped both of those at the same spot. The distance between GAN lines and fan lines and spirals and arcs and waves, and they're really very often portraying the same distance. They're just putting it in a different spot. I'm not saying they're all exactly the same. They're not. The formulas are different, but some of those tools are just redundant. Like the extensions, for an example. Someone asked me about this the other day. I use this, right? It's my everybody knows what it looks like. I put it in the chat all the time. It's my 111, my 1236, 786, and really, it's not the middle that we mess with, right? Between 0 and 100, we really don't use it for that, other than halves and 786, which really anything could be that, right? We could use 75 and half, which are the quadrants. The value of this one is the extension, not the middle. So someone asked me the other day, how come you just don't use the extension, the one that you click twice or three times actually to get it done? And I've never used that one other than when I need to use a Fibonacci and I don't want to use my own because I don't want to mess my levels up. Then I would use it. And I basically put them at the same point as where I started so that it behaves like a regular fib level would behave. I don't use it from an extensions point of view. But every one of those has been developed by somebody who wanted to show the data a little bit differently, or they wanted to um, use a, it's the same application, just applied in a different way. Some are ratios, if you look at the name, like that's a Fibonacci time ratio, and that's a Fibonacci time series. So the math is going to be a little bit different. The same thing with the other one down here. Where's that other one at? There was another one. I think it's the spiral and the arcs. Maybe it's those two. But there is a lot of the same things, just one is quote a ratio and the other one isn't. So you can play around with these and you can find something that suits you. But when it comes to like, why does it work? Especially with those fan lines. Just for an example, the fan lines, why does it work? I wish I had a really good answer for why it works. It doesn't make any sense, right? If you think about the activity of the people on the other side of the trade, if you think about the product that you're measuring and what you're applying them to, there's no basis and logic for why the hell it works. It just does, right? And that's a big leap of faith that is hard to take, especially for new traders, where they just look at it and say, I just don't understand it. Like, why? Who knows why? It just does. And it's such a poor answer to say that it just does, right? Like that just sucks for an answer. Wish I had something better. For me, when you have price in a range, that range could be, days long, weeks long, anything can be a range. So anything is a range, right? That is a concept hard to grasp, but one 5 minute candle can be a range. If it happens to be the 830 CPI candle, right? The 100-point long candle, doesn't matter. Whatever I measure, I'm going to call it a range. And when price breaks out of a range, but it's fake, meaning the breakout is going to fail and it's going to come back in again, most of those failures stop at 111. And so I use 111 to gauge, is this breakout real or is this breakout fake? Because if it's fake, price is going to break out and it's going to get tangled up in that 111 and fail, and it's going to come back in again. Most failures happen at 111. Now, if it gets through 111, that does not mean it's not a failure, because it can still fail at the 1236. But most failures happen at 111. The only thing that I want to start with when people are learning this is, what am I using 111 for? To identify where failure should happen if that breakout is fake. So if we get past 111 and we continue to 1236, it's no guarantee, but it's more likely that this breakout is going to hold. Now, by holding, that means we got above the 100 and that we're going to stay above that 100. But that doesn't mean that we won't fall down. We might get all the way to 1236 and then fall back to 100 before we continue on. And we could just get to 1236 stall out there and chop for the rest of the day. We could just stay right there and not get anything done and eventually fall back down after all. But if we're looking for that simple, typical, I broke price and now I'm falling back down again, that nearly, I don't want to say it that way, that happens a lot at 111. So we apply this looking at that 111 as if the breakout fails, it's probably going to fail at 111. So now that we've said that, come in and look at what price did here. I can apply it to the high of day. Well, the high of day that we had at the time before price broke out and ran. There was our high of day. There was our low of day. Price finally took off, started running, got to 111 and stalled, and then kept pushing. It couldn't quite get to 1236, rolled over, and down we went. 111 was where it should have just stopped there and fell. Instead, I don't know if it was news or what. This looks a little bit like a blow off top. It had one last little hurrah and then it fell. But that 111 was the shutdown point. It works. Doesn't matter. Doesn't matter. You could put it on bonds, VIX, dollar, the price of Pinocchio's cards. There's 111, reversal of yesterday. Same exact thing. Here's the high a day. Here's the low a day. We broke out, got to 111, rejected and fell. You have to have something to measure, right? If we don't have a top, then you can't apply it. Right. If the overnight session has a top, you can apply it. So, back up to what we had at this point. This is what we've got, right? Say it's midnight and I want to apply it. Great. I've got the low of the Globex. I've got the high of the Globex. Show me what you got. So here we got to 111 and rejected, just like we're supposed to. And yet it was still bullish. So the rejection happened, but it wanted to keep going. So then we ran up and we broke out of the high, set a new high. We could at that point just update the drawing. In fact, we could have updated it once we rejected here and fell down. I don't, but we could have. Say we showed up at our desk at 3 a.m. We're like, oh, look, we got the high a day, we got the low a day. All right, well, let's update the drawing. There's our high, there's our low. Price breaks out, gets to 1236, stalls and falls. It's still bullish though, so it kept pressing, kept pressing, kept pressing, and it broke out to the upside. You can apply it anywhere. You can, because at 9:30 in the morning we don't have any morning session, right? So what am I supposed to do at 9:30 in the morning? Well, I can use the Globex because it's all that I have, or I can use yesterday if I want to. Say it's the SPX, right? That doesn't have a Globex, then I could just apply it onto yesterday. So here's all of the Globex, high to low. I missed that high. Just there. Globex high to low, 9:30 bell rings. It's all I have, right? Because I don't have any 9:30 price yet. I've got the mid, the high, the low, and the 111 and the 1236. All I got to do is let price get outside of it. There's the 111, reject, come right back in. Now at this point, I have enough candles, right? In fact, after the first 30 minutes, I had enough candles. I could have just moved into the intraday, but I don't have to. I've got a solid range, prices inside of it. Show me what you got. There's 111, breakout failed, came back in again. and it got to the high at 1236 and it failed and it came back in. It's not better to do anything. It's whatever you would like to do, right? This drawing isn't giving you trades. It's giving you a way to analyze price action. So if it looks like the move is done based on you seeing price react at these levels where it's supposed to react, it's doing what it's supposed to, it's behaving normally, it's moving in the measured move that it should, which is really important because when price doesn't do that, we need to be mindful. So if it's moving like it should, behaving like it should, stopping where it should, turning where it should, I'm a lot more confident in trading it. Do I want to trade it to the green line or do I want to trade it after it hits the green line and falls away? Scalpers might run it up. Somebody else, say a 0-day trader, might take that high a day and sell some calls there and run it back down. You can do it however you like because we're traders. The lines aren't telling you to trade anything. They're just helping you read price so that you can make a decision to fit the style of trader that you are. That's the missing piece, right? Because the lines aren't telling you to get long, get short, get anything. One of my first things every day that I check for is price behaving normally? Because if it's not, I don't trade. So take this move the other day when we got data at 315 and the market just exploded up. That is unusual behavior. It is acting irrationally. It's a perfect example of it, but that's irrational price action. I don't want anything to do with irrational price action. Technical analysis is designed to look at what normal price is and extrapolate that into the future, anticipating when will we see this normal price action behavior again, and then try to trade it. If it's acting irrationally, technical analysis goes right out the window. Well, I use technical analysis, so I want to avoid when that happens. This run from 10 a.m. straight up with green candles nonstop all the way up, I don't want this. This is not the price action that I'm looking for. So anything that can highlight that behavior and say, hey, watch out, price is acting irrationally, it's misbehaving. Thank you. Thank you for telling me that. I now know to stand aside, to get out of the way, not mess with it. That's me. And it works just fine for that for me. All of these measurements tell us where price should stop next if it's acting normally. So if it overshoots and runs a nautical mile and just keeps on going, that's a beautiful heads up that tells me just get the hell out of the way. We had the low of the day and the high of the day measured right there. And when it broke out and crossed through the 1236 and just kept on running like a mad demon, I didn't look at that and say, oh, damn, I must have drew the lines wrong. How did I screw this up? I didn't look at it and think that. I looked at that and said, oh, thank you for telling me that this is misbehaving, as if I didn't already know because of the candles before. But suppose I didn't. It certainly told me when it overshot the 1236 and kept on going that this was misbehaving. These drawings are helping you better understand price action so that you can make an informed decision about the kind of trade that you want to take. That's the key to the whole thing. So if you do like that sort of price action, and if that's what you're aiming for, perfect. It'll help you find that too, because it helps me find it, helps me avoid it. It'll help you find it if you want to trade it. Keep in mind, price is supposed to be two-sided, right? So there's supposed to be pullbacks before the next leg. Generally, the pullbacks are smaller and the legs are larger, but they are uniform usually. And the distance is measurable, repeatable, consistent. If it isn't, the legs will get longer or they'll get shorter, which gives us information. The pullbacks will get deeper or narrower, which gives us information. So when we measure all of this and we're gauging how deep it pulled back to 786, if it overshot it or not, if it even made it there before it turned around, all of that is information. It's not implying we drew the lines in the wrong spot. It's telling us that the people who got out and the ones who took their place, they were so aggressive, we didn't even pull back to a 786. They jumped in and got long before we even reached that pullback point. Or if we break out and we don't even get to 111, and instead we fail before we get there and we start turning around and go back the other way, the breakout was so weak it couldn't even get to the 111. Like everything that happens, it's giving us information. So we want to use the tool and take that information and use it to better understand what price is doing. Now, I do tend to update the drawings through the day because I run a dynamic system. So if it's a breakout day and we continue to run, yeah, I'll use it for that and I'll update it as we run. But we don't have to. We can do something as simple as apply it to Globex or to yesterday's price action. Just snap it from the highest to the lowest and call it good. Now, I had just Globex there, so let's just do all of it because that is kind of the point. There's all of it. Yesterday's high, yesterday's low. RTH price opened, rejected the mid, came down, tagged the 111, and shut it down right there. Price behaving normally. Times where you might not want to use this sort of stuff would be, say, between 9:30 and 10. In the pre-market, there's what we call MOO orders, MOO, market on open. These are gathered up by brokers, big institutions, retail traders, heck, even you and me. We can put orders in that says, when the market opens, execute my trade. It's an MOO order. If you watch something like Finance Juice, they'll publish those MOO numbers once the bell rings. But all these orders are stacking up in the queue, just waiting for the bell to ring, and they're going to smack them at market price when the bell rings. We can be bullish as hell right up until 9:29, and when 9:30 hits and the bell rings and all those MOO orders hit, if they're short, we're going down. But we're only going to go down. We're only going to go down to wipe those orders out. And then we'll buoy right back up again if we stayed bullish, right? So what happens? We were bullish into the bell, then we dropped, shakes everybody out. They all get scared. They start going short. We run out of MOO orders and the market goes right back up again, runs over everybody who went short. And now we're long on the day again. And what's the retail trader saying? What the heck just happened? I got ran over. They faked me out. They didn't do anything. They didn't care about you. They put their MOO order in and the market rang and they executed the MOO order. Which sounds silly as hell to call it a MOO order, by the way. But there's an MOC order too, market on close, which does the same thing at the end of the day, executes trades into the close. So all these orders that are gathering up right before the bell and then get executed at the open, it's one of the reasons I don't trade the open. You've got a fire hose of orders coming in and data coming in. The bid ask gets really wide, really violent, and price action has nothing to do with those orders. You and I speculate. We think price is going to go up, we think price is going to go down, and we trade based on that speculation. But in the trading world, a lot of orders that come in are not based on speculation. They're based on getting payroll done or buying that coffee order that they bought or hedging something. They have no interest in where their SPY is going to go or the ES or the NASDAQ. They don't care. They're not even looking. They're only putting that contract order on because of some other reason, like coffee, cattle, wheat, hedging. It sounds crazy to you and me, but They don't care if the ES goes down or not, or the NASDAQ. That's not even their purpose for putting the trade on. So we can't use technical analysis between 9:30 and 10 when all those orders are coming in, when those orders aren't even based on price action or where they think the market's going to go. One of the big reasons why I don't trade the open. Same thing for why I don't want to trade in the last hour of the day, but really it's only the last 15 to 20 minutes when those MOC orders are coming in. Yep, sometimes it does take a little while. You're right. Sometimes it's 30 past 30 minutes, right? Like 10:30, closer to 11. It can be, especially when it's a market like today where we had 10:30 data, the petroleum reserves. Other days there's 10 a.m. data, right? Or there's an auction at 11 o'clock. All kinds of things can screw up the morning session. So if you are trying to trade in a violent time frame, say between 9:30 and 10, then good luck, because a lot of that price action isn't even based on price action. It's based on arbitrary things like who needed to hedge that morning and how much their hedging was and how easily they were able to get filled, how wide the bid ask spread got, and how many participants was there. There's an indicator called the ATR, and the ATR can help you pinpoint how violent price action happens to be at this particular moment in time. By default, it's run at 14. So I'm going to apply that, and you can see at the open, we were around 1.07, 1617. And then after the open, it got even more violent, and it got all the way up to 1.49. It got pretty wild there. So it wasn't just at the open, it got worse before it got better. Then it started to decay through the morning. Well, that's 14 candles. So let's knock it down to one candle or maybe two candles. We'll go to two. Let's see what we get. Now we can see that same level of violence. It calmed down right before the open, as it usually does when people are like, oh, dang, look out, the market's going to open. All right. So they stopped trading for a little bit. And then we open up, it got violent. And then it got even more violent. And then it started to calm down. So that violence, a lot of times it's random. There is a lot of analysts who will argue that the market is all random walk. I don't believe that. I think my lines and levels prove over the years that random walk always isn't true, but a lot of the market can be, especially depending on what time of day it is. Between 9:30 and 10, a lot of times that's random walk. Price is getting bullied around by individuals who are putting orders in who don't care at all what direction it goes. They just need their order filled. And so, of course, we get random walk out of that. You could, yeah, because it's helping you gauge the volatility of the price action. I like to use the size of the candles myself. I find that to be adequate, but I am a price action trader, right? So I like looking at the candles. Um, but maybe you're on a Heikin-Ashi chart, right? Or maybe you're using a line chart and you wouldn't see those. You would need something that could help you gauge that. ATR wouldn't be a bad way to go, but you should always anticipate that the open is violent, right? Like that's a given. The size of the candles are usually a really good indication of how much violence there is, and so that works pretty good. By default, you should just anticipate that the first couple of 5-minute bars is going to be violent. And sometimes it's not, but if you were prepared for violence and then you didn't get it, well, at least you were ready for it. I have a strategy that I used to trade called the 5-minute open range that literally just focused on that first 5-minute candle. And when that candle was a crazy, super tiny little 5-minute candle, it always freaked me out. I'm like, what am I supposed to do with this little itty bitty tiny 5-minute candle? You know what I mean? I wanted a really big 5-minute candle. So then when I didn't get it, it just kind of left me wanting. But now I use, a 30-minute, and it's more normalized. So I don't trade the open, I guess, is the long and the short of all of that, because it's not what I'm interested in trading. I want high probability, high conviction trades, not that random chaos. But it's an expensive allure. If you look at all of the statistics, we make big moves between 9:30 and 10, and people think that those big moves are how they're going to make big money. And so inevitably, they go in to trade the big move. It's like chasing fool's gold, but it's popular. Funny thing is, it's the same kind of argument that I used to make for everybody who was trading the ES when nobody was trading the NASDAQ. I was the only person in this Discord trading NASDAQ. Nobody else wanted to trade it. Everybody was on the ES. And they'd say, why you keep posting all these pictures about NASDAQ? We're all trading the ES. Well, I'm not trading the ES. I'm trading the NASDAQ. I don't care what you are doing. I care what I'm doing. Their argument was, well, the ES makes more money. You should trade this. It might give you more money per point, but the NASDAQ moves 3 times more points than the ES does. I'll make more money trading the NASDAQ. It took, what, a year and a half before finally people started to get that math through their head. And now nearly the. So the next argument that, inevitably will catch on around here is that trading the open might be the really big price action move, but it's not where you're going to make the big money, because it's not about trying to get 100-point moves and 200-point moves and 400-point moves. That's not the name of the game. At least it ain't my game. But I think it's catching on. I think that I've beat the drum often enough that people are starting to realize the open isn't where the sweet spot is. New people show up, right? New people show up, and then they get the new message. But for everybody who's been here for a while, I think most of us aren't trading open anymore. How soon? I've seen 945 traders doing pretty good. Alexa, thank you. Really, it always comes down to better for who, right? NDX versus SPX. If we're using those rather than, say, NQ versus ES, the NDX is an illiquid turd. These options suck. If you go in and look at the options on the NDX, let's go to the 0-day because it'll have the most volume. 200, 700, 400. Hey, there's 1,000 something. $2.50 wide, $2 wide. Just horrible, horrible stuff, right? Crazy expensive. And these have 15 minutes to go, and it's still $1,800, right? Yeah, really nasty stuff. So if you want to trade the NASDAQ in options, go to the Qs. It's your best bet. And a lot of people argue nowadays that the Qs are better to trade than SPY. I don't know about that, but I do like the Qs versus the NDX. So this is your better approach to trading in the NASDAQ if you're using options. Yeah. No, it's what we call skew. That's right side tail risk or skew. But I wouldn't read it as directional bias per se. The let's first say what is it? They're buying calls more aggressively than they're buying puts, right? That isn't my opinion and it's not me guessing. That's fact, right? So we know for sure they're buying more calls than they are puts. But is that bullish or not? They might be buying to close for all we know. We don't know, right? That so we can't put a bias in that by itself. What we can say for a fact is that they are buying more calls than puts. That is a fact. But I would have to guess or assume that they're buying calls because they're bullish, and that I'm just guessing. It's a safe assumption to be sure, but it is an assumption. So we always want to differentiate between what do I know for sure and what am I not so sure about? Right, because they're buying those. It's supply and demand basics, right? If if they're buying more of these and everybody's haggling to buy more of them, they're going to jack the price up. And on the sell side, if they're selling puts, well, isn't selling puts bullish? Yes, yes, it is. So if they're buying calls and they're selling puts, we can read all of this as bullish, but we're still making an assumption. We're assuming. All we can say for certain is that there is a right side tail skew and that the skew is that calls are bullish. Normally, that's not true unless we're looking at something like crude oil or VIX, something that's inverse market, because people don't usually fear the Qs going up, right? Or SPY going up. They usually fear oil going up or the VIX going up. So when we see calls more expensive than puts, it's showing that the market's buying more calls than puts. And that's just generally not the case. More often than not, people are buying puts because they're scared the market's going to fall. So they buy puts for protection. But if I'm looking for a trade and I come in and I see the options look like this and the calls are more expensive than puts, my brain doesn't immediately go, "Oh wow, the market must be bullish. Look, they're buying way more calls than they are puts," because I don't know what those calls are connected to. In the 0 day, it's not that hard of an assumption to make. But what if we stepped out, right? Went out 9 days and we looked at these options at the 607, and they are also more expensive than the puts. But it's been this way for a while now, right? We can go back days, probably weeks, where the calls have been more expensive than the puts, and yet look at what the S&P has been doing or the Qs. We topped out back in November, and we might have retested that same level here in January, but it's been negative. If calls are more expensive than puts, it's sure not bullish in the broader market. That kind of finishes my argument right there because that doesn't look too bullish to me. Now, skew, on the other hand, there's a skew chart. Even on Thinkorswim, we just come down here, product depth, set this to skew somewhere. Where is it at here? Oh, average. That might change what we have. I thought we had skew in here somewhere. No, it wouldn't be in the futures. Get out of that. This is today's. Well, we need a little more. We need something that's got a little bit of a curve to it. We'll use March. That way we got a little. This is a smirk, a skew smirk. It's not much because it just barely rises back here. But we would look at that at the money, near the money, and we would look to see if the skew is like that or if the skew is like that. And right now it's this one. On a different chart, different platform, we could probably show that a little better. Like if I went over to Quick Strike or something, show skew better, so we would get something on the right side over here. But it's that same basic math asking, are the calls more expensive than the puts? A lot of skew is run based on implied vol. I could have swore they just had a skew button in here, but without a skew button, just choose implied vol, and that'll give you the same outlook. The reason we use the implied vol is because when we're looking to see that correlation or the equality, say I go 4 out of the money on the call side and then I go 4 out of the money on the put side, those should also be equal. And if they're not, then we can see that same logic. So when does the number change? That's what we would use a skew graph for, to see that maybe on the call side, the skew change happens around 6:15, and on the put side, maybe it happens around 6:02, for an example. One is closer to the other. So then when the skew gets drawn, it would get hung up somewhere. And it could have started hung up, depending on which direction. Tasty Trade does a pretty good job of that too. I have about 5 minutes, and then I have an appointment to get to. I think we could pull this up real quick, though. Let me get logged in here. So when it comes to those quadrant lines, we only hit 111 today. Really? I mean, I think we really only hit 111. But the value of that is that no matter what you measure, and you can measure anything can be measured with that tool. We're looking for price to break out of wherever your 100 was set. And if that breakout is going to fail, then we're looking for that failure to happen at that 111. But it's not telling us price will fail. It's just saying, hey, if we fail, it's probably going to happen at 111. So here's Tasty Trade, and I'm trying to turn on all of the lines without actually putting a drawing in here. I might have to put a drawing in, but try it without. All right, we'll just throw a call in there. Zoom out. There we go. Now, let me delete that and keep it. Okay, we got the blue lines there. They might be a little hard to see in the stream, but here's where price is. And the thin dashed blue lines, that's the one standard deviation. These wider, more spread out dashed lines, that's the two standard deviation. And what we want to look at is the tail down here. These tails are really similar. At a quick glance, I can't really say that one side is heavier than the other. But if we had a lot of right side tail risk, then this side might be a really small triangle, and this one might be a very large extended triangle. And that would tell us, man, there's a lot more on this side than that side. Generally, the bottom side, what we call left side tail risk, is larger because there's those puts that are more expensive. The implied vol is greater on the downside. The puts are just more costly because people are buying more of them. And so we have more of that tail skew to the left. Right side tail skew is considered bullish, but as I just showed with that daily chart of SPY going sideways and down over the last 6 weeks, 8 weeks, we can say expensive calls are more bullish than bearish, but price doesn't reflect that. That's why I don't subscribe to that logic. It's making assumptions out of data. When I was in psychology classes, they taught us don't assume what the data is giving you, right? Take the data for what it is giving you, and then, add more research to it if you can. But if you make assumptions, you can just get in a train wreck. So I don't see it as more calls being bullish. It does make me go look for more bullish information, but I won't trade bullish just because of that. See, it's really hard to see, but right now it does look like the left side is better. This is using 22 days. I think I can change that, but I mean, really, at the end of the day, I don't think it would matter unless we go really far out of the curve. All right, guys, we made it through the topic list. As always, if you got a topic you want to hit on or got questions, a chart, a market, whatever, I love having something to talk about when we come in. So, hit me up when you got ideas and we'll go over them in the stream. I got this one recorded. Last week there was just something wrong with the recording and it didn't make it, but this one did. I kept my eye on it the whole time. So I'll get this posted into the Restream channel. Everybody have a good night.